Hello everybody, my name is Cucullu, and this is my company analysis. Um, these 10 companies that we will discuss today will be analyzed using the following ratios: um, current, quick, and cash ratios under short-term solvency, total asset turnover under asset management. For long-term solvency, we'll look at equity multiplier times interest earned and cash coverage. For profitability, we'll take a look at profit margin, ROE and ROA, and for market value, we'll look at PE ratio and market to book ratio. These 10 companies are split into two industries. The oil and gas industry will consist of Hornbeck Offshore Services, Secor Holdings, Tidewater, Gulfmark Offshore, and Halliburton. And for the home building industry, we'll look at KB Home, Standard Pacific Corp, Toll Brothers, DR Horton, and Leonard Corp. And there will be a diagram after all the ratios to evaluate each company's economic value added, return on invested capital, as well as the weighted average cost of capital. So first things first, we'll look at the oil and gas industry and short-term solvency ratios. We have three of them: cash, current, and quick ratios. For these, Hornbeck takes all three of them with the highest ratios, and Halliburton ended up with two out of the three lowest, and the other low was the current ratio for Secor. Secor ended up with the lowest current ratio, and Halliburton with the lowest cash and quick ratios. They're not very solvent as opposed to other companies. For long-term solvency, it includes equity multiplier, cash coverage, and times interest earned. These ratios were pretty much dominated by Tidewater. They had the highest by far for times interest earned and cash coverage, but Secor did have the highest equity multiplier, even though they were both all the equity multipliers were pretty much about the same for each company, within about a point or so. Let's see. For asset management, total asset turnover was the ratio that we looked at. They were all pretty stable throughout each company, but Halliburton did have the highest. They were the only company to be above one for this ratio. Offshore was the worst performer in this category. They did have a steady decline throughout the past 6 years, up until 2012. For profitability, we'll take a look at each company individually. Hornbeck Offshore, as you can see, in 2007, their ROE was at about 18, and now last year in 2012, they were down to around 3. So a big decrease in that ratio, as well as with their ROA and profit margin, showed a pretty big decrease. For Secor Holdings, they also showed a decrease. You're going to see this is consistent with all the other companies in this industry, due to mainly the gas crisis and the oil spill of 2010. So after 2010, Secor Holdings ROE dropped from 13 to just above 2. So you could see what it did to them. Same thing with Tidewater. They went from 20 in 2007 for their ROE to about 3 in 2012. Their ROA decreased from 14 to 2, and their profit margin from 31 to 8. So a significant decrease for them. Gulfmark Offshore, same case. From 07 to 2012, they went from 16 to just below 2 for their ROE. ROA had about the same impact, and same with profit margin. And Halliburton, although they did show a decrease, it wasn't as severe as some of the other companies. Some of the other companies' profit margin went down maybe to like an eighth of what it was, but Halliburton's just below half of what their profit margin was in 2007 to where they are now. So pretty stable company. For market value, um, Secor did have the highest price to earnings ratio, which is not necessarily what we want. And Halliburton did have the highest price to book ratio, which can be a good thing. And Gulfmark Offshore did have the lowest price to book ratio. So now we're going to take a look at the weighted average cost of capital screen for each company. All these companies had a negative economic value added, which is your net operating profit after taxes. And then you subtract your capital charge, which will give you your economic value added. You can get your capital charge from your total investment capital times your weighted average cost of capital. That'll give you your capital charge. And then to get your ROIC, you just take your net operating profit after taxes and divide it by your investment capital. And that'll give you this percent here. You take this percent and subtract your weighted average cost of capital, and that will give you your economic value added spread. So instead of being expressed as a number, it will be shown as a percentage, which is much easier to compare throughout companies. So we'll see that Hornbeck is at negative 6.4%. For Secor, they're at negative 4.9%. Tidewater did perform the worst in this segment. They're at about close to negative 16%. For Gulfmark Offshore, they're at about negative 8%. And Halliburton is negative, but they did perform the best, under this, finishing with about negative 1%. So best and worst. Halliburton seems to perform the best over the past few years, having the highest ROE, ROA, and total asset turnover, as well as the highest economic value added spread out of all the companies. They also showed stability in its ratios, as opposed to other companies that seem very volatile. So they've shown that even in a crisis, they can still perform and still grow their company. But Tidewater, although having the highest ratios in profit margin, cash coverage, and equity multiplier, they showed signs of decline over the past few years in their ratios. They're really struggling and losing some business, and I personally wouldn't make that investment. All right, so now we'll look at the short-term solvency ratios for these. Leonard Corp did have the highest for the current ratio. On average over the past 6 years, and although they did have this, Standard Pacific did have the best average for cash and quick ratios, so including cash and their current assets. Without their inventory, they are more liquid than Leonard Corp. So now we'll look at long-term solvency. These ratios include equity multiplier, times interest earned, and cash coverage. KB Home did seem to perform the worst out of any of these companies, and Toll Brothers did seem to perform pretty well. They were stable over the past 6 years, more so than any of the other companies. D.R. Horton did have the best times interest earned ratio, and they were pretty consistent in the cash coverage ratio. And Toll Brothers did have the highest cash coverage ratio in 2012. So now we'll look at asset management. Total asset turnover again. From 2007 until 2012, there is a steady decline in the total asset turnover, sales to total assets, throughout each company because of the housing crisis around 2007 or so. So you could see from 2007 to 2008, there is a big decrease in each company. Um, so none of them really performed very well for this ratio, although the company that did show the most stability for this one would be D.R. Horton, which only decreased by about 20% over the past 6 years, whereas other companies were over 50% decrease in total asset turnover. We'll look at profitability now. KB Home, this is a screenshot of their profitability. They were the worst company in this category by far. All their ROE, ROA, and profit margin is negative. They haven't really shown any signs of improvement, and we'll see what they can do in the future. Here's Standard Pacific Corp. They have shown in 2012 that they can bring up their ROE. It was negative from 2007 to 2011, along with their ROA and profit margin, which is now finally positive. For Toll Brothers, theirs remained pretty stable. It's actually increased from 2007 to 2012, and along with their profit margin, so they're looking much better after the crisis now. D.R. Horton has substantially increased their ROE from 2011 to 2012, and along with most of the other companies, they're showing signs of improvement with their ROA and ROE and profit margin. Leonard Corp, same case, negative in 2007 after the crisis, and now they're positive at 21 for their ROE, along with their ROA and profit margin. And as you can see with all these companies, the interest burden is fluctuating like drastically, so it's very unpredictable. But now we'll take a look at market value. KB Home did seem to perform the worst, having a PE ratio right now of about 1,000, so not really doing too well. And in 2012, all the way back to 2009, Bloomberg didn't even have a number for their PE ratio, so we don't see any incentive to invest in this company. Standard Pacific dropped down a good bit in their PE ratio for what's projected in 2014, and their market to book is pretty stable over the past few years. And Toll Brothers is steadily decreasing their price to earnings ratio, which is a good thing, and their market to book has been pretty stable as well. D.R. Horton is showing the best, I believe, for these ratios, and they've shown some stability, along with Leonard, who's also shown very solid ratios for market value. And now we'll take a look at their weighted average cost of capital. For KB Home, their economic value added is negative. Their EVA spread's at -12. And Standard Pacific Corp, their EVA spread is at about 7.8, and their weighted average cost of capital is higher than most others at about 16%. For Toll Brothers, they are just negative at negative 0.26% for their EVA spread. For D.R. Horton, their EVA spread's at -3.83,